This short commentary forms part of a series of such commentaries which are available on the website, whose site is listed at the end of this video. This one addresses problems with the concept of economic growth. Economic growth is the principal objective of most governments, but it is a tricky concept and its blind pursuit can be misleading. This is usually measured in national accounts by gross domestic product at market prices, a measure of the output of the economy. This is calculated from total domestic expenditure, allowing for exports and imports. However, other adjustments may be made to arrive at a measure of real national income by calculating net national product at factor costs, by taking into account indirect taxes and subsidies, net property income from abroad, and capital consumption. There are three methods of calculating GDP: total expenditure, total factor incomes, or the sum of value added. These rarely produce the same result, and together with improvements in the available data lead to frequent revisions. There are further technical difficulties in distinguishing between intermediate inputs and final goods. For example, is the investment in education a final consumption or investment in raising productivity? Further, there is the problem of the treatment of transfer payments like social security benefits and pensions, and the impact of inflation. Of most relevance to countries is, however, the standard of living, and this is measured by dividing GDP by the size of the population, that is, GDP per capita. Significant differences arise when this comparison is made across countries. Thus the UK, with its large GDP, has a lower GDP per capita than the Irish Republic. The standard of living can increase with a constant population, but increasing total GDP through increased productivity, or by an increase in GDP and productivity faster than a growing population and labour force. The emphasis in most countries has been on the latter. It is here that some of the problems of Europe's strategy of mass migration in the post-war years to maintain GDP growth has come into question. If new additions to the labour force have a lower productivity than the existing average, then they will be lowering the available standard of living. As much of the employment creation in many European countries has been in low-wage, low-productivity activities, the beneficial impacts of migrant labour employed to fulfil those roles may have compromised growth in the standard of living. Productivity performance should be reflected in the level of remuneration in competitive labour markets. Thus, improved labour productivity should be reflected in higher wages. However, much of the improvement in productivity is likely to arise from technological change embodied in capital, and it is possible that much of the return to that improved productivity will be received by the owners of capital. This is becoming an issue with the debate about the impact of AI. The result may be a significant increase in the unequal distribution of income, both between those parts of the labour force who are able to exploit this improvement in productivity and those who are not, and between the shares of capital and labour. For governments, however, this increase in productivity may be extracted to fund general public services, and this is often the motivation of governments to focus upon the priority of achieving the maximum rates of economic growth. A further major issue with a focus upon growth is the existence of externalities. These arise when the costs of economic growth are not accounted for in market prices. Indeed, the need to undertake expenditure to compensate for the impact of economic activity may itself contribute to the measure of economic growth, creating what may be termed phantom growth. For example, the need to treat polluted water will itself appear as part of the measure of economic growth when the capital investment is made, despite this not really representing a net improvement in real output or in the standard of living of citizens. Indeed, it is more usefully viewed as a necessary intermediate input rather than final output of the economy. One of the most significant examples of this externality arising from market failure is the capital investment necessary to combat climate change. Thus, any meaningful debate about economic growth needs to take into account the conceptual difficulties, problems of measurement, and adverse consequences that can follow from its adoption as the principal economic objective of any government.